friends. Welcome back to the Wall Street Skinny. I'm Jen,
I'm Kristen.
and we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street, here to give you the skinny on the global markets, the deals that create the news, and the world's highest paying careers. And today we have another incredible episode for you where we're going to speak with Dominics, who is the head of US credit strategy at Barclays. And credit has been one of the biggest topics that everybody who is focused on the markets is speaking about. Private credit, public credit, refinancing existing debt, deals getting done, where interest rates are and where they are headed is pretty much top of mind for everyone who is controlling capital these days. And so understanding how people are approaching the strategy of the markets, I think, is really critical. And we're going to get an understanding of what a career looks like in credit strategy as well, and how that differs from, say, equity research or other elements of strategy that we've talked about in the past or are going to talk about in the future. But first, Kristen, what's going on with you?
Not much. I sent you some pictures yesterday. I have a 2-year-old who kids like to eat books. I don't know why. And there's this one book in particular that she ate and literally destroyed. It's disintegrated. So I bought another book and it came. And yesterday, I think it arrived at like 3:00. And by 3:45, it had like bite marks in it. And I'm just like, do you need dinner? Like, what is wrong with you? And it's weird because it was like only that book. It was Happy Hippo, Angry Duck, which is the Sandra Boyden book. I love Sandra Boyden books, like for little kids.
She's
but anyway,
amazing.
they're the funniest books. But I don't know why. It's like that one book. It's just like super yummy. So anyway, so that's not that exciting. But actually, no, they're really exciting.
She's going to be a very talented reader when she grows up.
Yes. Yeah. No, I actually am really excited because my mom flew back. She spends the winter in Florida and she now has flown back, which means I now have help for the summer.
Oh my gosh. Oh, wow.
Yeah.
So this is it. So she's in town for the next several months.
6
That's
months.
great.
Yeah. So I am
is
super
amazing.
pumped. It gives us so much more flexibility to do things. I feel less bad about travel because we have a lot of travel coming up. So yeah. Mm-hmm.
Oh, that's amazing. Let's tell your mom I say hi.
I will, of course.
So let's talk a little bit about credit and where we are in the credit markets as of the time of recording this. So historically, when we talk about credit, we talk about spread-based product. And what does that mean? So when you think about a company that's issuing bonds, that's borrowing money, the rate at which they borrow money is determined by a quote unquote risk-free rate, which we typically use US Treasuries as the proxy for, plus some kind of additional charge that's reflective of how likely or unlikely it is that that company is going to repay the money that it has borrowed, right? Yeah. And typically when people are trading credit, they are trading that spread, and they will isolate that spread by buying the corporate bonds and then selling US Treasuries or paying on swaps against them to isolate that credit spread and trade it as it goes up or down. You can also trade it in the credit derivatives market via CDS, which we've talked about before. There are a number of different ways to express this. Historically, most credit trading has been done speculatively in a spread-based way. However, with rates having sold off, meaning gone higher so much recently, we're actually seeing an environment where yield-based buyers are really overwhelming spread-based trading. So you're always going to have real money buyers like asset managers. You're always going to have retail buyers like you and like me, whatever. Yeah, exactly. Whatever portion of our 401k is allocated towards some kind of corporate bond portfolio, whatever that may be. But the real drivers of yield-based buying right now, when you think about it, are institutional players who have very long-dated liabilities, right? If I'm a pension fund, if I'm an insurance company, and I have very long-dated liabilities, think about, a pension that I'm going to need to pay out 30 years hence, or life insurance policies, or whatever that may be. As rates have sold off and gone higher, Kristen, you know this from the banking standpoint, right? When you think about a very long-dated liability, you're going to discount that back and calculate its present value based on where rates are today. And guess what? Rates are much higher. So those long-dated liabilities, right? The big risk is if rates rally considerably, if rates go much lower and you suddenly have to discount all of those rates back 200 basis points richer, they're going to be worth a heck of a lot more today. So they need to invest in something. They need to buy things to offset those long-dated liabilities. What are they going to buy? right? They can buy a number of different things. So they can buy US Treasuries, okay, but we all know the yield curve is inverted. So US Treasuries are trading at relatively rich levels relative to the front end of the curve. They could receive on interest rate swaps, but I think 30-year spreads are something like negative 76, meaning rates
What?
on interest rates. Yeah, meaning all swap
Yeah.
spreads are negative. Meaning in the
Oh.
post-LIBOR era, we can talk about swap spreads another time, but
We'll have to, yeah,
swap
because
spreads,
I
swap
don't,
spreads have been negative
yeah,
for a very long time. The spread itself is negative, meaning swap rates
crazy,
are lower than US Treasury rates because there's so much
crazy.
demand to receive. Correct. Because there's that huge
Wow.
liquidity
Okay. Yeah,
premium for
we
receiving
need to have a whole
derivative space
conversation on that.
versus
Yeah,
owning
yeah.
cash.
Okay.
Yeah. Because
Yeah, yeah,
funding rates are so high.
yeah.
So you don't really want to receive in swaps. Why would you receive 76 basis points lower than the risk-free rate, right? So what are you going to do? You're going to go out and
Mhm.
buy higher yielding stuff as far as you can out the curve. So those yield-based buyers have really been the driving force of who is causing the credit market to be so bid. And they are not so price sensitive. They aren't a hedge fund who cares about a quarter of a basis point here and there. They don't care if on a relative value basis, credit spread look 10 basis points rich or cheap. They don't
Mhm.
care about that. They're for the long haul. And so
Yeah.
there is a ton of demand in the credit markets right now. And it's very, very topical too, as we think about kind of the next phase of borrowing for institutions, for people who are buying companies and need to fund those purchases in the market and what that looks like. So understanding how credit strategy and the big picture plays into all of that, I think is really critical.
Yeah. So we had just talked about the fact that Jane Street had got out and raised money, and it was obviously on a rate basis. It was like an all-in yields, or as you say, all-in yields of 7.25%, I think. But as you put it, they're probably there thinking, well, we'll just hedge that out. So it's a view on credit spreads, because we had a lot of people asking. They have so much money, and the same question that we had asked, which is like, why the hell are they raising money today? And it's like, well, could be a view on credit spreads. It's the same.
It could be. Yeah. I
We have
don't
no
know.
idea.
That was just my personal speculation. I have no idea why. I mean, also, listen, if you weren't in a position where you could tap the capital markets and for whatever reason your balance sheet is so strong that you now can, sure, go ahead. Why not? If they
Yeah.
think that they can out earn whatever that rate is that
Yeah.
they're paying on their debt, you're supposed to borrow money, right?
Yeah, yeah,
So
yeah, yeah,
clearly they think rates are low, I guess.
yeah, yeah. Awesome. All right. That was a really great explanation of what was going on in the markets. And
Thanks, Ben. Let's bring Dominic
yeah,
on.
So today we are joined by Dominic Toublon, who is the head of US credit strategy at Barclays Capital. And Dom, you have an incredibly impressive resume. I would love it if you could just briefly walk us through your bio and your work history, because it's very unusual. Well, it's funny. Everyone we get on here, we're like, unlike everyone else. And then we're like, wait a minute, everyone's story is so unique. And everyone, didn't know they wanted to be in finance from birth. But could you tell us a little bit about where you got your interest in finance, how you came up through academia, and ultimately how you launched your career?
Hi, Jenny. Hi, Kristen. Thanks for having me. Yes, not a straight line for me, definitely. So I grew up in a small place in Switzerland, up in the mountains. I did my undergrad, my PhD
Wait,
there.
which town in Switzerland? I'm so jealous.
Oh,
Kristen knows that my lifelong dream is to live in Switzerland.
My village is called Eremans, which is up in the mountains somewhere. But I grew up in the
Amazing.
big town of 10,000 people called
Ooh.
Munich.
Actually, our town that we
I was
grew up
gonna
in
say,
outside of Boston
yeah,
had 10,000
yeah.
people, maybe 13,000 by the time we left. A booming metropolis.
Exactly. So I grew up there. I did a PhD in physics there, nothing related to economics. Then I got some grant to go somewhere. I decided to come to the US. Then the usual stuff. I wanted to stay for a couple of years, and then I met my future wife to be, and here I am, been like 20 change years in the US. So that's how it happened.
What sparked your interest in physics?
Since I was a kid, I always loved math. I love these kind of things. I was intrigued by silly things. You'll see, I think, in our conversation, like a little kid, I see something shiny and I run to it. It's kind of my MO in more ways than others. So I was in Long Island for a little bit. Then I went to Illinois, where I was a professor there. And then I was not so thrilled anymore about it. I just didn't have a kick out of it. And, you have to be self-motivated when you do this, because there's no boss or something like this that tells you what to do. So I thought I want to do something else. So finance is always something that interested me, but kind of a hobby on the side. But I also realized that I needed to do something different if I wanted to do it the way I wanted to do it. Meaning I did not want to be a quant. And it's, again, matter of taste. You might like to be programming, that's fine. I just was not my cup of tea. So talking to different people, I realized that I should do an MBA or something like this to switch. Part of it because of essentially signaling, right? If you show up and you say, I used to be a physics professor, I want to work in finance, you know exactly what, track they're going to put you on. And that's not what I wanted to do. So long story short, my wife was working at GE at the time, so she sponsored me for the expensive MBA. I was at Wharton with your husband. It was very good 2 years, fantastic people, fantastic experience, life-changing for me in many ways, professionally and others. And that's how I got to the market, right? The other thing that a program like Wharton offers for you is that it opens many, many, many doors.
Yes.
So it was relatively easy for me to go around and say, this is what I'm good at. This is what I like to do. Is there anything at your bank that people would be interested in? I did not know that credit strategy existed.
Right.
I landed into someone that was doing credit strategy that I really, really like interacting with. I did a summer internship with that person. I really loved it. And then I just came back and here's, the last 15 years of me.
So for you, it was really about identifying the mentor and the team that you wanted to work with. And the product was almost secondary as long as it facilitated the kind of intellectual lifestyle that you were looking for versus being a quant or a programmer.
Yeah, that's very fair. And having, in some sense, the back of my head that I know I will have more math skills and stuff than most. And to be in a place where I know I can use that to my advantage.
And before we get into what credit strategy actually is, I'm curious from your perspective, from being so advanced in math and physics. I never did any math more complex than algebra at best during the decade that I was working on the street. Was it like taking a step back almost intellectually, or were there so many new things that you had to learn that it was still intellectually rewarding when you first jumped in?
Remember what I told you about shiny object? So yeah, it's a little bit of that. So first, in the complexity of the math, definitely not as much, but there's different problems that you're facing. And at the end of the day is the scientific approach. How do you look at a problem? So a lot of things I do, I know I do differently than others because of how I learned to approach a problem through, doing the science path, if you want. So that I think is a bit of a difference. So in terms of the process, it's still something that stays there. It might be visible process for others or not. It doesn't really matter. It's just the way I would approach things. It's funny because I do go as a guest lecturer at Wharton or at Columbia once in a while to discuss some of the stuff we do. And it's still an unexplored territory for many, what you do in kind of systematic trading, quantitative trading in the corporate bond market. A lot of it is discussed in equities, in rates, etc. But there's other problems that we are facing there. One of the biggest problems is that we have thousands and thousands of bonds. It's not like the S&P 500, we have 500 companies. We do have 500-600 companies, but we have thousands of bonds. So how do you deal with that? And so these are different problems, but it doesn't mean that they are not difficult to tackle. It doesn't mean that there's some subtleties around it. The math you use is different, fair, but I still think it's interesting problems to tackle with a scientific method, if you want. So in many ways, what I didn't like in academia is I think you get the 80-20 wrong. You spend an enormous amount of time to cross the T's, dot the I's, and all that stuff. In the market, if there's something I think about that's interesting and could be fun, let's push it out. If people don't care, move on. If people care, well, you can do the next level, the next iteration in that kind of question you're asking or trying to highlight. And so to me, that makes it way more dynamic and, again, interesting. A question of character of what you like to do and how you like to, being dynamic around you. There's flip side to this, right? When we have traders, clients, and all this asking you, bombarding you with questions all the time, and you have to push aside something else you like to work on. That's the flip side of it. And if you're comfortable with that, comfortable with the workflow, then that's okay.
Yeah, I love that. So before, I want to hear more about the exact timing of when you started your career, but I want to get into what is credit strategy. And this is embarrassing because I interacted with strategists all the time during my time on the street. But if you ask me to explain this to my 8-year-old who is, spoiler alert, not in the financial services industry. What exactly
Not
is
yet.
credit strategy? Not yet. Last night he was asking me questions. He literally was like, Mommy, what sound did the Big Bang make? And I was like, oh boy, this is not going to be an on-time bedtime. So now we've got Dom, you need to explain that to the business.
Yeah.
There was no sound. There was no air.
That's exactly right. There was no air. That's what I said. So I got it right. Okay. But Neil deGrasse Tyson would be proud. So what is credit strategy? And also, what is the difference? Is there any between strategy and research?
Okay, so let's look at what we do, right? So we look at companies at the end of the day. Companies need sometimes to borrow money to start a big project, right? So I don't know, I'm a baker, I need to buy some new equipment, and well, maybe I don't have the cash at hand, so I'm going to go to Jen and then say, well, can I borrow like, I don't know, $1,000?
You're barking up the wrong tree. Go to Kristen.
And you're going to say, sure, but you give it back to me in 5 years or whatever. So that's debt, right? So
Yes.
A lot of what we do is to look at debt. So we have sector analysts with a capital A, as people tend to say, not the juniors, but senior people that have been doing that for many years, that look at specific companies, what they do. They look at the debt stack, they look at how they operate, etc., and say, we like this debt, we don't like that debt. Okay. So I'm not doing that. What I'm doing is kind of higher perspective, in some sense, 10,000 feet, saying, what if I gather all this stuff and I try to look for themes, right? Because you might be, I don't know, the tech analyst, and you really know everything about all these companies in super detail. You can go really deep. You know the CEO, you know everything. I don't know all this stuff. I know the language you're speaking. I'm going to understand the balance sheet and all this stuff, okay? But altogether, is there a theme that I can think about? Is there something that is more kind of a larger discussion? I don't know. So in tech, can I discuss AI and tech and how it impacts companies? And then ultimately, which companies you like better, or which bonds you're going to like better, because that's what we're looking at. So again, there's thousands and thousands of bonds, just too many for anybody's brain to capture. Can you kind of take a step back, look at the big picture and say, aha, these are the themes I see. And then what I'm doing is research, right? It's called a strategist, but it is research. We're publishing research. We're talking to clients and internally as well to say, aha, when I look at the big pieces moving around, this is how I think about the puzzle. And really, this piece is really interesting. This piece I don't like, at a very high level. And then we have this constant dialogue with the analyst to say, what do you think, right? So I give you a simple example. The US consumer in 2023, much, much more active and buying stuff that essentially anybody had thought. Cool, that's macro data you can get if you look at sales and stuff. But now I can go to my analyst and say, what did this company, Walmart, let's say, what did they say in their earnings? Does that make sense? Does it tie up with the rest? Does it give me a different signal? So that's where I'm sitting, in between the macroeconomist, if you want, and the person that looks really into the weeds and say, these are all the details. And I'm kind of in between thinking about what's the implication of macro for the companies, but also hearing from the companies and say, what are they telling me about the big picture as well at the same time? So that's a sweet spot for me where I am, because I do like what companies do and how they think about the market, how they think about their environment, etc. But I also like the macro stuff, right? What is Powell going to say next? What does that mean for the rest of the world? So that's what credit strategy is. It exists in equities as well, right? There's an equity strategist. Most of the time, the people you're going to see on TVs and stuff like that are going to be strategists more often than not. They're just doing the equity side. I'm doing the bond side.
Dumb question. Do you guys talk to the equity strategists and liaise with them in equal measure?
Absolutely. So quick example, something we did recently. There's lots of money in money markets. We're at $6 trillion. What happens next?
That's the wall of cash?
That's the wall of cash. What happens next to this? And then what's the dynamic? So how do we put that together? Well, we work with our short rates analyst because he understands deposits and money markets very well. And then we discuss with the equity analyst as well, and myself, to say, where does it go if it moves? What can we say? Is there something historically we can say? There's something in the current environment that might be different. On my own, I wouldn't be able to do that. And that's the cool thing about that as well. It's, again, very dynamic. We put something together. It's a question that one of us asks to each other. And they say, oh yeah, let's bring in that person, and I think we can get an answer. And then you work a couple of weeks on that, you publish something, and then you see the reaction and if people are interested or not. And then if there's more interest, you push more.
Can you walk us through a day in the life of someone who's doing this process, both at the senior level where you are, and then someone who's like an analyst? I mean, are they in the models? Are they doing more coding stuff? Is it all more like high level macro, like reading? Like what exactly does it take to produce that thing that you're then putting out? How does that come to be?
It's kind of all of the above. So let's describe like a regular day. I wake up a little bit before 6. First thing I do is I read a few things that I like to read every morning, because I have to be ready for 7:15 when we have our meeting. I'm going to speak in front of all the traders and sales that trade our market to say, this is what I'm thinking. This is what's going on. A couple of highlights, short and sweet, right? Nobody has time. 3 things that you think are interesting that might be important. So it depends on the day-by-day basis of what's going on.
Right.
And sometimes it's something as simple as, well, IG is not investment grade, sorry, is not trading the tightest it has in whatever number of years, whatever. Mm-hmm. What I do, which I do differently from others, I try to think about everybody and help them as much as I can. So for instance, these 3 points I highlighted during the meeting, which is we sit, we're in a room together. I just post on the chat to say, use it, right? The salesperson, copy paste whatever you want. I don't care.
Former sales, thank you so much, because you make us sound smart.
Whatever I can do to help. You credit me, you don't credit me. It doesn't really matter, right? It's again trying to think there. Same thing with the traders, right? Maybe they were not in the meeting, maybe they were not listening, maybe there's a number that if you say 10 numbers in meeting makes no sense. So just a few places that you do this. And then during the day, it's going to depend a bit. At the more senior level, you're going to have more meetings with people, right? So there's tons of calls, tons of meetings and all this stuff. We travel quite a bit. I was in Cali last week. I'm going to Middle East next week.
And most of these meetings are with external clients of the firm,
with
right?
External clients, exactly.
Yeah.
And often, you're going to travel with a senior trader to do this kind of things, etc. Right? So that's when you get to the senior level where you take way more time with the client interaction, right? Mm-hmm. Take a step back. We're in the service industry, and like any services, we need to take care of our clients. Again, if you're a baker, you have to be smiley and nice when the person comes to buy the bread. Otherwise, they'll be, well, why do I come to your place? It's the same thing for us. We have competitors, and maybe they come to you because, I don't know, you have a nice smile or the best bread or whatever, or the best price, whatever it is. It's going to be why people come. So at a high level, it's just the stuff that you can think about in any kind of service shop. When you go to the more junior people, if I take the most junior, there's a lot of stuff out there. And there's so much you learn by kind of being a sponge over time. And you just, oh yeah, I know this happened before. And there might be things that haven't happened in 5 years. Yeah, I do remember something like this happened. Impossible to know when you start, right? So there's a lot of things that you have to learn kind of by osmosis, little by little. And some of it will be to go into build the model, see how it works, what doesn't work, right? In my experience, in anything I've learned, it's often easy to know, oh yeah, I understand what is working. Okay, now do it. Oops. There's a couple of things I didn't realize, and I don't understand anymore. And so learning that way, right? So again, everybody's there by 7, essentially. Everybody's at the meeting. And then during the day, it depends what the workflow looks like. If there's a client or internal asking for some details of screening some things or, looking at models, my preference is that they go directly to the people in my team rather than through me, because I like people having ownership. And then over time, what you try to do is, people now have some confidence, then grow in terms of your relationship internally with the salespeople, with the traders, and then with clients little by little, so that you build a brand, you build a portfolio of internal, external, so that you start to be known and kind of more and more fly on your own. That's kind of the path, if you want.
And really dumb question. We've talked a lot about the models that investment bankers are using. We haven't touched on them as much, but we've talked about some models that traders are using. What models are the people on your team building when they're looking at a bond or a portfolio of bonds or, a corporation?
So most of it is relatively basic things. Some of it is on the kind of sorting data, meaning, again, there's thousands and thousands of bonds. So how do you efficiently identify the one you want to buy and the ones you want to sell? So that is done more and more these days. It moved from Excel to like Python. So there's some usefulness there. Again, it's not that it's high math, but it's, oh, I would like to have all this type of bonds that are trading this way, that way, and versus the recent history, give me the 10. Okay. And then often when we do this, which is kind of a sorting exercise along criteria that we like, and it might be around a theme more often than not, then we go to the sector analyst and say, okay, these are the 10 bonds I found. Kill the one that you find shouldn't be on that list, given the overall theme. Right? That's the way we tend to process. We're right next to the analyst. We're all on the trading floor. So that dialogue, that dynamics has to take place all the time to be the most efficient possible. So that's one of the big chunk of things. Sort things around this criteria and find what it is. Then there's others that maybe rely more on the regression, for instance, right? So let's say, I don't know, these two things are trading far apart. Can we understand why? So somebody in my team, just to give you an example, last week, regional banks, of course, it's a big theme, right? Regional banks, and they don't trade that well in the equity market, in the bond market. Can we explain where they trade by just a few things, right? My ideal situation is I can understand what's happening using 4 or 5 things. And then when I discuss with you, I'm going to say, yeah, these are the 4 or 5 things that matter. What I try to do the next step, again, with my more quantitative background, is can I put numbers around this? Not just qualitatively, oh yeah, if they have more commercial real estate exposure, that should be worse for them. Well, how worse?
How much?
Exactly, how much? And then to me, that's the interesting question that I think I do a job a bit different than others. So what did we do? We put, and I didn't drive this. The person in my team really drove 90% of that. He realized that using just the exposure to commercial real estate and the credit rating explained a huge amount of where these bonds were trading. It's fantastic framework, right? And now we can start to discuss. Now we can say, oh, this one is expensive. And then you develop a thesis and you say, oh, this one is expensive, this one is cheap. Let's discuss with the analyst. This is the frame, the screen that we have, the frame that we have. Intuitively makes tons of sense. But now we have numbers, and then we can discriminate this versus that. So that's the ideal situation on how we get to model, to interaction with the analyst, and the practical answer, right? At the end of the day, we want something that's practical, that's impactful, and differentiated. That's what we try to get. Nobody is forced to read our research. Nobody is forced to trade with us. How do I bring you to do it?
And how much of the balance of the research that you do, what you just discussed to me sounds like a relative value framework for analysis, but you talked earlier about that macro framework for analysis. How much of the research and strategy that you guys put out is, hey, we're playing for a correction of 2 basis points versus an overall move of 200 basis points?
So it's a very good question, because in my head, there are really 2 timelines that I always have to think about, right? There's the short term, 3 weeks, 1 month, something like this. And that can be more the relevant stuff, the more tactical things. But I also want to have that 10,000 feet view, kind of credit cycle perspective, right? Where are we in the credit cycle? How is it going to move? So to me, by experience, for most clients, kind of a 6 months timeline. 1 year is already too much. There's so much things that can happen between, in 1 full year. So most of the time, a 6 months perspective is what you want. So that's where the big picture kind of intervenes, and the way I think about the big picture in the world and say, okay, what's the macro environment looking like? What's the credit fundamentals looking like? What is the supply in bonds? What is the demand for bonds? And what's the valuation? And so in this big step back, is it an interesting market to buy overall? Is it not? So these are the 2 kind of timelines you have to think about kind of all the time. It's a little bit what we discussed earlier in terms of your workflow. Sometimes you might be bombarded by a request, internal, external, about short-term stuff. But so you have to push aside the 6 months perspective for a little bit, but bring it back when you have a little bit of room to breathe.
How do you see AI being incorporated into your day-to-day?
Because of my background, there's quite a few people from the financial engineering part of the world that contact me. And I always have the same answer. To be able to get the biggest footprint you want, you need to be able to communicate with others. That you're a pure quant or not a pure quant, to me, makes no difference. You're going to have to convince people internally, if you're pure quant, the higher ups, the key stakeholders, that do not understand what you do. So how do you make sure that you can communicate to them in the language they understand? And it's the same thing for me, right? Simple anecdote. A senior salesperson when I started at JP Morgan said, don't put PhD on your business card.
Really?
And there was
Why?
extremely good advice.
Why?
Because
I
it
never
frames
thought
things differently. He's the geek. He won't understand he won't speak in normal terms.
Interesting. I bet if you put PhD on a salesperson's resume, that would actually probably help them because it differentiates you from all the old school sales dudes who are just 3 martini lunches.
So I was doing, synthetic CDOs and tranches, close to Kristen, what you were doing when I started.
Yes.
So it was still okay for the beginning, but as I expanded and did more and more less mathy stuff, or perceived as less mathy, it was a good advice. And then people learn over time, professor, doctor, whatever, some nicknames that I have. But that's okay, right? Because it becomes a nickname rather than the core of what you do.
And that's a good nickname to have, professor.
It's not too bad when you walk in with a new job, with a new senior person, and the guys at the big shop says, "Hey, professor, how are you?"
That's exactly right.
Okay.
My old boss at Morgan Stanley used to call our strategist, our interest rate strategist, Drago, because he looked like Drago from Rocky. And it was funny because I was like, this is so insulting, like, because he's this blonde Russian guy. But actually, it was kind of genius because he was this very meek nerd.
Mm-hmm.
And he used that to empower him to feel confident to go out with our clients. Hey, it's Drago. It's, the tough guy from the boxing movies, right? That's exactly what he was doing.
That's very good.
I was going to say, it's just like, I do think it's to your point, Jen, it's like, if it differentiates you in a good way, it can definitely be an asset, but it can also not. So it's like, it's almost like knowing where to take it out and be like,
where to lean on your credentials. Yeah. Where
exactly.
to play that card.
And I had no clue, right? That person was very nice and just said, just don't put it there.
Yeah.
Okay, I listened to you. You've been doing this for a while. You've been successful. So I don't know better. Let's try it. So the second thing, Kristen, to your question is, it is quite clear that the availability of data, the availability of model and all this makes everyone who has abilities in quantitative techniques, data techniques, a more desirable person in our industry than 5-10 years ago. Things are evolving quite quickly, and systematic trading importance is increasing, even in the corporate bond market, where that is probably 20-25 years behind the equity market in that perspective. And a lot of it was because data was not available, as simple as that, right? So I think there's lots of stuff to do there. But again, your ability to communicate and interact with others is going to be key for you to be able to progress, in my experience, in a way that's satisfying and enjoyable for people. On the AI side, all these technologies are coming in. There's just no way to avoid it. Practically speaking, they are impacting what we do. So we are, piloting some stuff, trying some stuff internally. The key question for us for all this thing is about compliance.
Yeah.
Because if it goes, essentially the question I ask is, revealing what I'm thinking about, is it going somewhere outside of the company? And then compliance-wise, this is not desirable. So that's the constraint we're trying to operate under. But it is penetrating what we do. And some of the things and the pilot stuff that we've done are absolutely impressive. So I have little doubt that it's going to continue to increase in importance and the impact of what we do. But even just think about this, just my small universe, right? So Lehman, Barclays, the whole many years of research that the company from Lehman to Barclays has published. How do I search into this? We are currently at yield levels that we haven't seen in 15 years. There's not that many people who were working pre-credit crisis that are around and tell me, look at this note from over there that I wrote in 2007. That's going to be tough. So how do I search through that? How do I get information quickly extracted? That helps in this basic way in some sense.
So much of what I did in my past life was I would go to, universities and business schools, and I would teach people how to build a financial model. That's probably going to not be necessary anymore. But the key thing that was always so crazy is I would teach someone how to build a model. They'd be like, I literally learned now all about accounting. Like it made all these lights click on because the actual doing, the creative helps you internalize things that if a freaking chatbot just spits it out, it's like the sales growth is going to be this. Cool. But you don't process that information the same way as if you created it. So I do worry a little bit about how are people going to learn some of these concepts, right?
And to your point, Dom, that process of being a sponge, right?
Yeah.
You can't be a sponge when you're interacting with a computer.
Yeah, totally. I'm old, so I remember when I would go to an encyclopedia or something like that and flip through and you'd stumble into something. You don't do that when you Google something, right? You get right to the answer. So I think it's the role of the more senior people when new people come in. How do I do this, right? Because I don't want to put aside this new technology because I think it is helpful. But how do I make sure that we use it in a smart way, that we still have the osmosis going on? It's not an easy question. It's, I think, a question that everybody has on the table from, grammar school to a job.
A couple questions for you. Can we talk about, you mentioned a little bit early on about your role in interacting with clients of the firm. The firm's clients who are interacting with the credit division of the firm are going to range from everyone from conventional asset managers like the BlackRocks, Vanguards, Wellingtons of the world, to hedge funds who are very active in this space, to more high frequency trading shops, things like that. What's your communication like with them? You talked about having that 6-month sweet spot in terms of the investment horizon that you're speaking to. But how does your interaction differ, and how do your trading recommendations differ for those different client bases?
Okay. So as we said, we are in the services industry. I have to understand what my clients are and adjust to whatever the client wants, right? At the end of the day, that's the way you want to operate. So if it's a more high frequency person, the 6 months perspective, they still want to discuss, but then they're more interested in the tactical, super short-term trades, and the type of questions they have tend to be more geared that way. They might also be more quantity than others, and again, to me, that's fine, and we can discuss.
You can put on that hat,
stuff if I need to. Exactly. I talked about how do I differentiate myself compared to others. What's my competitive advantage, if you want? That's definitely one. And I come from the derivatives world when I started in this business, from, as we were discussing earlier, in some synthetic CDOs, in tranches, etc. Credit derivatives. All this is where I started from, and so I can do that stuff if I need to. If I go to people who are more real money, not as fast money, if you wish, so some pension funds, some life insurance company, etc., the 6 months discussion maybe takes a little bit more time. We spend more time on this, but there's still the tactical stuff, right? They still need to deploy money today, tomorrow, right? They're receiving money to invest. What's the right tactical trade is still the question you want to ask. But also a lot of what's happening in this discussion is, I don't have the truth. I only have two eyes. What are you seeing? What are you thinking about it? And I'm totally fine to agree to disagree. That's fine. At the end of the day, what most people want to avoid is to be blindsided. So if I come with a thesis that it's different from others, from what people are thinking, we just discuss. We discuss how I built it, how do I get there, how do I think, why do I think this is the case? And maybe it's because I've done that for a long time. I'm a Swiss guy. I'm considered even keeled and all this. It's okay. There was that yelling in any meeting as was that, but there can be some disagreement. But I learned stuff from that side as well, right? Because they might push back against something. I was like, oh yeah, maybe they're right. I should think more about that
way.
Or there's things that I don't know, right? Are they receiving more money? From where? I don't know, right? I'm not in a seat where I see that stuff going on. So again, very topically, in 2023, a lot of money came into the fixed income market, into the corporate bond market. Is that continuing right now? A lot of the data I would get from the macro side or from vendors and stuff will be late. But if I go around and ask Jen at your shop, are you getting some money? Oh, from here, interesting. Kristen, at your shop, are you getting? And it could be hedge fund, could be real money. It doesn't matter.
Right.
So that's why I always try to do in these meetings that it's a dialogue.
It's a two-way street.
It's exactly. And you exchange information, and you'll see there's some people that will not give you too much information, others that will be more open, some not so different than I'm the baker and this person's going to be chatty and that person won't, right?
You talked about your previous experience in derivatives. We've talked a lot about your strategy from the cash perspective. Do you still cover derivatives in equal measure? Are you talking about the credit indices and CDS as an investment strategy in equal measure to, just cash bonds?
Yeah, so the bottom line is CDX, the indices are the most liquid instruments in credit. So you just can't avoid them. You can't avoid them as an investment vehicle. You can't avoid them as a signal because they trade so much. So thinking about what people do on the CDX actually impacts what people do on the cash bond side. So the way it is in the teams, today, I spend much less of my time talking derivatives. I have a senior person in my team that does that, but it's a discussion that we regularly have with clients. I spend most of my time on cash because it's a path that I wanted to follow. I wanted to move from derivatives to cash because I thought the footprints was bigger. There were bigger clients doing that. There was their concerns day in and out. So if I look at the regular meeting I have with people, even in hedge funds today, the weight of cash is increased on the hedge fund side compared to when I started in 2008.
Interesting.
And the people who are looking at the bonds, they discuss the derivatives on the side more than it's a tactical instrument, more like a strong view instrument, right? It's going to be in our discussion, oh, do you like this sector, that sector, these maturities, etc. In CDX, it's just one thing that is
long short.
Long short, exactly. Can I tactically have lots of money? Do I need to invest or just whatever? Sorry,
can we also just back up for a listener who might be very new to this whole thing and not understand what it means to be synthetic versus cash and all that kind of fun stuff? Do you mind just giving us the high level overview of what CDS/CDX is? I know that's a big question, and then how that kind of fits into the answer you just gave.
Yeah. So as we discussed earlier, right, companies issue bond. They need to borrow money for doing, CapEx, for whatever they need to do. And they borrow money to kind of operate. That's done in the bond form, right? That's why we call it cash, because they get cash for the bond for the money they borrow.
Yeah.
Now, over time, what's happened, and it's kind of early 2000s, people started to say, oh, can we build a derivative on the credit worthiness of a company? You have a company, and I'm really, really very worried that you're not going in the right direction. I bought some bonds from you. And the next 6 months, there's some big hurdle. I don't know, maybe there's a lawsuit against you. Maybe, I don't know, something. And I want to say, okay, is there a way that I can keep the bonds, but can immunize them for a little bit until I feel comfortable? If I feel completely uncomfortable about the situation, I'm going to sell you bonds and I don't want to have to do anything with you. But in the meantime, because getting this bond is not always easy, can I just hedge myself?
Yep.
So that is done in a synthetic way, meaning there's no, if I buy $100 of insurance, I don't really put $100 on the table, right? I'm going to pay a fee for that insurance. So that's what you do in credit derivatives in a nutshell.
Got it. So basically you are buying the insurance in case this company goes bankrupt, they can't pay back their bonds, you get paid what you're losing with the bonds. Otherwise, you keep collecting your coupon payment, all good, everyone's happy. So it's the insurance piece. Yeah, I think
exactly. So more or less what happens, the fee you pay is what you get paid on the bond, in terms of interest payment, etc. At the high level, that's what it amounts to. So this was quite successful, and there's a lot of development that happened around that. And so people decided, oh, we could bundle them. So we're going to do an index, like with 100 and change single name CDS. If you want, each of these credit derivatives is pointing to one specific company. Let's take 100 of these things and putting in a basket that you trade in one go. And that's been super, super successful, right? So CDX on its own, every day, one instrument trades about as much as all the bonds in that same subset of the market.
I mean, probably actually more, right? Because those single name bonds are so illiquid, relatively speaking.
That's right. And so that's why you cannot avoid it in terms of an investment vehicle that you want to use, or as a signal it's sending you, right? If people are taking a lot of risk using CDX, it signals that tactically they want to deploy money. So that should have implications for the rest of the market. As Jen said, the other stuff is much less liquid. So what do people do? What do you do if you get a big chunk of money today and it's like, I have to deploy it immediately? Okay, let me put that in this liquid thing in CDX. ETFs today also are very popular. And then little by little, I'm going to take that position off and deploy it exactly where I want it to be. But it's going to be impossible for me to do that in 1 week. Maybe I'm going to take 2-3 months to get there. So that's why people use these instruments a ton these days, to be able to quickly react to some money to deploy, some money that gets out, etc. Right? So many investors think about a liquidity sleeve in their investment portfolio, right? Something that in my portfolio is easy to get in and out, so that I don't have to get out of my core positions that are illiquid.
I've never heard it called a liquidity sleeve before. I like that.
And so CDX is one of the things you use in that liquidity sleeve.
Oh, that's so interesting. But no, that makes complete sense, because I mean, like, if you think about it, you have individual companies, and like the company is only issuing so many bonds, which means there's only so many out there. So it's not easy to buy and sell them. I remember when I was doing converts, we'd have to like look up what the yield was on certain things, and we'd be like, well, the last trade was like, 3 weeks ago, but okay, to your point, they're just not liquid.
And they go into strong hands a lot of the times, that are buy and hold accounts. They aren't, trading around in the float on hedge funds.
That's right. The pension fund, the life insurance company is going to keep these bonds for a very long time, because what are they thinking? Their liabilities are very, very long term. When somebody bought a life insurance contract, they try to put assets against it that also long duration, because then kind of, again, balances the assets and liabilities.
One of the biggest questions we get all the time, backing up 10 steps, when Kristen and I first started this little adventure, private equity was all anybody was talking about after the boom of the last 10 years of QE forever. Now we are getting asked daily about private credit being the new hot thing. And I'd love to hear your take on how the structure of the private credit market is impacting the overall origination cycle, the investment cycle. And when I hear things like, I think JP Morgan said something the other day, like, we're getting into private credit. Well, JP Morgan's getting into private credit. Isn't that just credit? Like, I'm very confused.
So at a high level, what's the difference? At a high level, the difference is that when a company decides to issue a loan or bond, right? Generally speaking, it's on the loan side. If they do it through the historical process going through a bank, it means that it's broadly syndicated. What does that mean? It means that there's going to be many people that going to have a piece of the debt you issued, right? I don't know, you issued $100 million of that. There's going to be a big, 50 investors, 100 investors that hold a piece of that.
Sure.
So companies don't necessarily like that, because if there's something that happens and they need to go back to the investor, to the creditors, and say, we would like to renegotiate that a little bit. Could we change the terms a little bit? If there's 50 people in the room, it's very tough.
Yeah.
So the private credit essentially can be up to one lender direct, right? So it's going to be, I'm just going to go to you two, and I say, I want to issue that debt. Are you interested? And then if there's an issue, it's easy to sit at the table.
We can all sit down and chat and talk about it and figure it out.
Exactly. We can figure it out.
Versus trying to find some grandma in Ohio who's got these bonds locked away and doesn't even know about it.
Exactly. Something like that. So that's one aspect. The second aspect, in terms of the growth of the private credit market, which has been really, really fast in the last few years, is that the yields that you were getting, the return you were getting on fixed income post the credit crisis were very, very, very low.
Sure.
And so what private credit was able to achieve is to make the returns higher by essentially telling companies, sure, you have an advantage by doing this one-on-one lending, but it should cost you a little bit more because you're asking for something. There's no free lunch. You'll have to pay a little bit more. And companies were like, okay, I'm fine doing this. So a lot of it was that. And then the last piece is regulations, right? Regulations are increasing for banks all the time. After the regional bank situation, it's increasing even more. We saw recently with NYCB that, there could be some issues for some. That means that there's a part of the lending market that banks used to do that they don't necessarily do anymore today because it's too complicated with regulations, etc. Banks have limits, right? If you think about what banks need to do, if they have too many assets on their balance sheet, they need to issue, there's a capital cushion that they need to have. So there's going to be a limit to what banks are going to be able to do. So that leaves the door open for somebody else. Nature hates vacuums, somebody else finds a way. And that's in a bit what's going on right now. So today, when a company is deciding to issue some debt, they do look, what is private credits or people will do? What is a bank going to do? What's the difference between the two? Do I like this one better than that one? And that's the way companies playing on all the possible sources of financing that they can find, which is completely legit and normal. So I think it's kind of these three factors that have led the private credit to increase so rapidly.
And how does it impact the secondary markets, this shift in widening the range of origination options?
So the first impact is on the primary market for the public markets, meaning there's less issuance, right? Meaning companies have more choices, and so all else equal, there's less they're going to do in public markets, right?
Yep.
The private market has grown. There must have been some cannibalization, right? The second aspect on the trading, then on the secondary market, it needs there's fewer bonds to trade, and so that's
liquidity is down.
So liquidity can be impacted. It depends where exactly. Yeah. But we've seen that in 2023, many companies that, particularly those that had floating rate debt, where they were most sensitive in interest payment to what the Fed was doing, their interest cost was increasing quite a bit. So how do we refinance things, right? So do I go to private? Do I go to do some other construction I can do to find these funds? And so that, again, contributes to people's imagination has no limits, and so you find a way to survive as a company. Which, again, it's totally legit and normal to do it that way. And so private credit today is a completely kind of standard, if you want, solution that companies will adopt to finance themselves.
You see this all the time too in the real estate market. There's the conventional lenders and there's the hard money lenders. And a lot of times you have people who could never in a million years get a loan from a bank because they don't meet certain criteria. And they're willing to pay, if they would be paying 5, 6, 7% at a bank for a conventional loan, they're going to paying 12% and not batting an eyelash because it's financing they otherwise would not be able to obtain in order to fund those projects because they're too highly levered. They don't have the proven cash flows, et cetera, et cetera, et cetera. And so those hard money lenders are making bank all day because the default rates on these things are historically extremely low. And so that's the big difference with these portfolios and with these companies that have been LBO'd by a private equity company, right? That would not pass the sniff test to refinance their debt at a bank. They can go to another private lender who says, I understand this risk perfectly and I'm willing to charge you for it and I'm going to make a fortune because you're going to be just fine.
Yeah, and you can, again, discuss directly, right? You're the CEO of that company. We sat down, we discussed. I believe in the project you have. I know that. And that's why you have more and more in terms of employment and all this, more and more people going there because you do need to have people to do a good job. The work you need to do is not that different from the people who were doing debt capital markets and all that before at the bank. It's just displacing where things are coming from.
It makes a lot of sense. Another question that we get all the time is from the career trajectory standpoint. So, you came from academia and moved into the strategy world. I think that path is probably unusual relative to most young people who might be listening to this or people who have come up through credit strategy or maybe thinking about exit opportunities. What do you look for young people coming up through the business in terms of qualities that you think make them successful candidates? And what are the traditional or typical exit opportunities that you see out of credit strategy if someone says, hey, on to the next thing?
So broken record, service. So the first thing is, can you interact with people? You're going to be in the middle of a trading floor where we all, super close to each other, as you both know, and the interaction sometimes can be intense. And how do you manage this? Are you okay? Can you, keep your calm in some sense and understand when there's tension and understand interaction with people and all that, right? So can you communicate? Are you okay in this environment that sometimes can be high pressure? And how do you respond to that? So my first question is, are you comfortable with that? Are you okay that sometimes somebody's going to come and completely derail what you had planned to do in the next hour, in the next 2 hours? And that's, you're okay with that, and it doesn't rattle you.
How do you adjust for that in an interview? Just have someone barge in the door in the middle of the interview and be like, interview's off. See how they react.
I guess that's why I'm a side office right now, not on the floor. It would be impossible to do this on the trading floor. The second aspect is, again, we're spending a lot of time together every day, right? So are you a person I want to sit next to? Am I okay to spend all this time next to you and not after 2 hours I say, oh my God, would be next to. I don't want that, right? So that's the second aspect. So far, nothing about quant, nothing about markets.
Nope,
nothing,
I haven't heard
right?
any. I haven't heard any hard skills yet.
Now it comes a little bit. You do have to be comfortable with numbers, right? At the end of the day, we do manipulate a lot of numbers, so you need to have to be, again, comfortable, literate in some of the things we do. There are some things we do that are a little more complicated than others, but that usually is not the bulk of the team that does that. Is 1 or 2% in the team that, when I think about the team, I hire because they know that I know they can do that, and I need these skills. But not everybody needs to have these skills. Like, so if you know what a regression is and stuff like that, that's going to be already plenty.
Okay, got it.
And it's just, do you like it, right? Do you like the markets? The thing I always hate the most is somebody who comes and says, "Oh, I love the credit market. I always wanted to do that." So, okay, so tell me a little bit about it. And then there's nothing. That to me is the worst. If you just tell me that, I like the markets, I like finance, I don't really know what credit market is, but it seems interesting. It seems that it matches some of the things I want to do. I'm fine. I understand that this is a market that most people don't think about, that there's many quirks to it and whatever. I'm okay. I don't need for you to know that, but don't pretend. Pretend is the worst thing you can do for yourself. If you don't know, obviously. If you know, then that's fine. So that's kind of out of a high level the way I think about it, right? It's going back again to you're in a service industry that deals with numbers. Nothing that's revolutionary in what I just told you.
Well, I do think it is surprising hearing from a strategist that effectively sales and communication skills are the two things that you look for first. And this is just a theme in every single conversation we have. Yeah. Exactly. Even when we talk to quants, it's how can you communicate, right? Literally, that's the first thing. Like, what is the human thing? So it's such a theme because, Dom, I can't tell you, every single day we get 100 messages saying, what certification do I need to break into this industry? And everyone's like, no, I don't care about your garbage certification. I don't care. Go take 10 level 85 CFA. It doesn't
People
matter.
Get so annoyed, by the way, too, when we're like, you don't need the CFA. And they're like, they get like annoyed. It's like, great, then what do I need? And it's like, but that's not.
There's no magic bullet. There's no magic stamp on your resume. It's who you are as a person, and being curious and fun to be around too. You want to work with people who are fun to be around.
Totally. And I think you're right. Being curious, being open-minded in all this is important because, as we discussed, we are in a dynamic market. Things change quickly. Nobody has the God-given right to be correct, right? That's what I tell my team all the time. Is the only thing I know is I'm going to be wrong at some point.
Well, and humility from a strategist is so critical because you are putting out a published piece that says, here is my view. This widget is going up, whatever it is, and it goes down the next day. And I mean, the first couple of times that happens, that must be, I don't care who you are. I would really struggle with that. That's got to be hard.
But isn't it true for every function? If you're a trader, it's the same thing. If you're a salesperson, you recommended me to buy this thing, and then 2 weeks later, it just craters. And
but as a salesperson, you're like, I'm just a dumb salesperson. You shouldn't have listened to me. Like,
oh, so if I shouldn't listen to you, I don't call you back, right?
Or as a trader, it's like, it was just a tiny position. That wasn't the one I had the big conviction on. I don't know. There's something about having your name and it's public and it goes to everybody. I don't know. Like, that's something that I would be so, I don't have the guts to do that. I think that requires a lot of bravery and a lot of humility.
I frankly don't think it's that different, but understood.
I think I also think, like, we spoke to Steve again, the equity research analyst, about this, and he was like, we get it wrong more than we get it right. Like, right. You'd at least hope it was 50-50, but he's like, we serve more than just that function, right? It's the relationships we have with the CEOs. It's a service job. It's a sales job. It's a, and yes, communicating and all that, but he was sort of just like, yeah, if I was at a hedge fund and like I was trading on it, that wouldn't be good. But that's not like, we're explaining kind of like what's going on and the dynamics and the fundamentals and all that stuff. And I also think people understand that there can be things that happen in the market that have nothing to do with fundamentals. Like, we've talked about GameStop. You believe that the fundamentals are garbage, and yet the price goes up because you got a bunch of people in their basement who think that it's cool to buy this thing, and they see the price going up, and it's like, all right. So it's like a momentum thing, but ultimately things will come back down to reality. So I think there's a little bit of that.
No, that's true. When there are surveys that are done about what people are looking for in research in general, being strategy or sector analysts, one of the first things that people are are citing is not your view. It's do you reply in a timely fashion and with good content? Are you accessible, when they try to reach out? Very service kind of things. The view matters at the end of the day, but to me, it's more to discuss. I want to have a view. Generally speaking, when that's just my bias, even though I'm Swiss, I don't like to be neutral. I like to say it should go up, it should go down. I don't know, because I think it makes the discussion more interesting. And you have to be able to live with a call that you file that you think is right, but your level of comfort might be low. You want to say that's, I don't know, on a 1 to 10, I think it's if it's an 8 over 9, it's easy to do the call, right? But sometimes you say, I think it's a 6 or a 7, but I still want to push it out. Because at the end of the day, take a big step back. From the sell side perspective, why do people even trade with us? What's my function in that perspective? To me, there's 3 things. It's going to sound like a consulting now. There's the capital.
Yeah.
How much the company, the bank is giving the traders to trade with, how much inventory they can build. That's going to depend on how much capital they do. The second one is the calendar. That's for the credit market. How much is our syndicate issuing every day? How much connections they make between the companies and investors to issue debt? Because the more you do, the more trading is on the back of it. And the last piece is what I do is content. Can I be differentiated enough in my content that you will want to trade with us? And that's the gentleman's agreement, that you're going to say, oh, I saw this neat idea from Barclays. Let me come to them. I'll trade with them. I give them the last look or whatever, the usual thing that you will do. But that's my function. My function is just not to be, I'm this guy that has some view on the market and it's going to be fun to see what he says. I'm not a charity, right? At the end of the day. And that's something I had to learn over time that was not obvious to me at the beginning. In some sense, what I'm doing is marketing.
Yep. When I was working, it was that gentleman's agreement of this is our competitive edge. We have these brilliant strategists. There are a list of 10, 20, 30 reasons why a trader might show a trade to your firm. But strategy might be that key determining factor. And that's how you're, at the end of the day, compensated and graded. Is it still that way in the current environment, that it is part of the overall value add of the firm?
It is still the way in the credit markets. It's still
That's
the way it functions. And there might be some different flavor of it from one company to another, because I worked at different companies. But generally speaking, you interact a lot with the salespeople, with the traders and all this, because you want to think about what's the overall picture. And they know that I'm spending a ton of my day doing this, but I also know that they see the flow all the time. So if I don't understand the flow, I'm just missing out, right? I'm just in my ivory tower thinking about the market from the high level. At the end of the day, there's supply and there's demand and you have price, right? That's just the way it is for anything. And so understanding with them and getting pushback from them is always interesting. So for instance, what I try to do during the day is, there's some news coming out and I'm just going to put a short commentary. I think this is positive, negative, whatever, right?
Yep.
And might be right, might be wrong. It's okay. I just have some rationale that is super short, quick. Again, as we discussed earlier, if you're a salesperson, you copy paste, or maybe it helps you engage with some client you think that could be interesting, right? So give you some ammunition that helps you give a call. Or if you traders, okay, I understand. But then I love it when they say, actually, we don't agree, or client XYZ is pushing back against this. Great, let's have a discussion. Gives me an occasion to just pick up the phone and say, okay, let's discuss. How do you think about this?
Yeah.
I only have 2 eyes. I talk to many clients. There's many eyes in the market. There's many smart people who are looking at this. I've done for many years successfully. And I don't think I have a better view than they do. The only difference is that I'm in the middle of the marketplace and I talk to all of them. That's the difference.
Yeah, it's the asymmetry of information on both sides, right? Like you said, again, a pension flow is going to know when they need to rebalance better than you are from one second to the next. But you know that, well, pension funds are doing that and hedge funds are doing this and asset managers are doing that.
And therefore, the relationships you build over time are super important, right? Because I might need to be able to call COVID time. Hey, how are you thinking about the market here? That's the way I think about it. Like, you never go just to ask a question. You try to build win-win situations all the time.
Then last question, because we've kept you way beyond our time. We're so grateful, Dom. I did want to circle back on what the exit opportunities are for people who are coming up through strategy, who maybe say, hey, listen, I'm looking to do something else. The obvious thing in my mind would be going into trading, possibly, but I'm curious to hear what you tend to see in the industry.
So just talking about my teams over the year, there's a little bit of everything. There are people who moved into trading. There are people who've moved into sales. There are people who went into other parts of the bank. Some people went to the buy side. Generally speaking, most people I've worked with have stayed within the financial industry. But it's really going from some people who do kind of risk stuff inside the bank to a trader in Asia today, etc. Right? So there's really a large amount of things. At the end of the day, you're probably not the best equipped to look at a specific company because you really didn't spend a ton of time building company models. But besides that, you're well equipped to understand the ebbs and flows of the overall environment and then focus on some tactical stuff around that. So generally speaking, it's not a bad kind of background to have in terms of thinking about what's going on around you and trying to distinguish the signal from the noise, generally speaking.
But you don't tend to see a lot of, or do you? I'm curious, in the current environment, I've noticed that sales and trading, historically, sales and trading was much more of a possible route to build a long-term career, and of late has turned into more of a talent farm for the buy side, like investment banking has traditionally been. Are you seeing that in strategy at all, that people are there for 2 years and then all of a sudden get itchy feet? Or is it much more of a long-term career trajectory for the average person coming up through strategy?
Because I'm such a great boss, I don't see that.
Good answer.
So no, just joking aside. Generally speaking, what I found, and it goes back to who you hire. That's the most difficult thing I have to do. It's to hire the right people. So generally speaking, I find that people like this stuff and are happy to spend several years doing this stuff. It's always hard to tell ahead of time. We make mistakes in hiring like we do in everything else. But generally speaking, I find that can last for some time. But again, as a manager, you really try to think about this and how do I make sure that the person is happy, the person kind of develops, right? So to me, it's what did I like when I did it? People give me ownership. Okay, so then I can be the face of doing this or that. My goal is to say that the head trader, when he has some questions about some specific thing that I said Kristen is the specialist of, and she's going to be the whatever guru of that stuff, that the head trader doesn't come through me, but just goes directly to you.
Yeah.
Right? And so little by little, you grow like this, making sure that when I do a client stuff, I bring you along, right? Just what are clients talking about? This is so important. Or asking the salespeople to say, hey, if you have some events with some more junior people, bring them along, right? So how do you build this? Because I think at the end of the day, for somebody who's intellectually curious, there's lots to offer in that perspective. For somebody who likes being around other people, there's a ton of things you can do there. So on its own, I think there's quite a few things in it that are inherently interesting for people who like this kind of things. And then it's for us to make sure that you thrive there, you feel you have a path in front of you and that it's growing, right? So that's what you try to achieve. Again, hopefully you succeed more often than you fail. But in my experience, there's not that many people I've worked with which just stayed that a couple of years and decided to leave.
This is actually very unique relative to most people we have talked to. Very few senior managers we have talked about nurturing someone's career from start to finish in the level that you just did, with the amount of thoughtfulness you just did, with zero eye to preparing them for the next path, which I think.
But it makes sense because you were a professor, right? I think that it's clear, you care about teaching people how to do things and developing them. I do think it's, the best type of manager or mentor you can have is someone who likes to teach. And so I feel like people who come and work for you, they kind of won the jackpot. So
they really did. I know. I was hearing you say all that. I was like, you're doing all the right things. It's so true, though.
But again, it's just a question of my boss when I came into the industry, praise to him. that's the way I felt when I was going. And I
Yeah.
said, that works. This is good. I like it this way. And then
Yeah.
again, you were talking about earlier, the humility of being a strategist and coming out and say, this is the direction we go to. I think it applies to everything else, right? So I'm always asked the people in my team, I regularly have one-on-one meetings with them to say, tell me, am I doing something wrong? Is there something I should do differently? Because
I love that.
I just don't know, right? I try to do something that I think is correct, but what do I know? Sometimes it's going to be off. And as we all know, in human relationships, you might try to do the thing that you think is right, and it just resonates wrong, or just whatever. Just be honest about it and say, okay, maybe I can change this. But other times, obviously, I'm, also saying, no, sorry, that's the way we're going to do it, right? Because I think that's the right way to do it. There's also a limit to what you want to do and how you want to do it. So
Right.
I also give feedback to people, say, yeah, here I think you could have done better, and let's discuss how we can do better and going forward. So I love nothing more than some people who got the feedback that maybe was, difficult for them to swallow, and then I see very quickly them trying to change and do something differently. And I'm the first one to say, my PhD advisor told me this. I'm going to tell you when it's right. I'm going to tell you when it's wrong. I think it's the best way to do it. My daughter thinks the same.
I was gonna say, I bet your 15-year-old daughter has some very strong views about how you manage. No, but this is fabulous. Any parting words of wisdom for our listeners?
No, thank you. I mean, the parting words would be: have fun, look around, have some views of what you want to do, have some plan about what you want to do, but be open to something that's slightly different. It's like, oh, it still matches what I want to do. The 80-20 that we discussed earlier also applies to your career. Have a view, that's cool, but be ready to just update it with new information.
Oh, I love that. I absolutely love that. Well, thank you again so much for your time. This was absolutely phenomenal. We were so lucky to have you on here. Thank you, Dom.
Thank you.
All right. Wishing you and your family
So
all the
good
best.
to meet you.
Bye, thanks. Nice to meet you.
Bye.